Hi, everyone. Welcome to our first PENTalk of 2020, the Secure Act and its impact on you. I'm Beth Parker with Pentegra. We're glad you joined us today. Before we jump into the Secure Act, I have a few housekeeping items to review with you. First, I want to draw your attention to the control panel that's located on your screen. If you have any questions during the presentation, please submit them through the question box and we'll get to them at the end of the webinar. We'll answer as many as we can. We want to ensure we're respectful of your schedule and end on time. If we don't get to your question today, we will follow up with you. Also on the control panel is a handout section. Here we have posted a copy of today's presentation along with an overview of the Secure Act. I invite you to download these resources now, or you can download them anytime during the webinar. Let's get started. First, for our first PENTalk of the year, we're joined today by our in-house expert, Rich Rouser, Senior Vice President, Client Services. Rich has over 30 years of experience in the retirement benefits field. He's visited over 1,000 clients, is a regular speaker at industry events, and has done multiple media interviews. Rich holds many professional credentials, including his CPC, Certified Pension Consultant, his QPA, Qualified Pension Administrator, and QKA, his Qualified 401k Administrator. Rich, thanks for presenting today. Let's get started with the Secure Act.
Good afternoon, everyone. Thanks for attending the webinar today. We in the retirement community, retirement services community, we're always thrilled when there's some new legislation, and this is a big piece of change in law that's coming down pretty much over the next couple of years, and a lot of it's effective right now in 2020. So we're going to go through the major components. I think there's about 19 separate items I'm going to talk about today. There's a couple of pieces that I'm not necessarily going to talk about because they're not totally on point with the retirement services side of the business. But again, this is the first major legislation we've seen since the Pension Protection Act of 2006. So the Secure Act basically stands for Setting Every Community Up for Retirement Enhancement, and it's an act that was born in 2019. Signed into law on December 20th, so this was just literally a couple of weeks ago, and a fair number of the provisions are effective right now this year. The act is broken down into about 6 sections. The bottom of the slide, you can see there's plus even more. There were a couple of other things they snuck into the spending bill at the end of the year, and I'll touch on a couple of those that might have been contained in the minors bill. Anyway, so with that said, we're going to dive into this presentation, and I'm going to go through, let's talk about the high level first of all. Again, the legislation in and of itself, it's got a lot of positive measures, all right, designed to improve retirement readiness, which is always a good thing for plan participants. It's always a good thing for plan sponsors. Several of the items that are in this legislative effort are in some of the thought leadership that we produced 4 and 5 years ago. So it's good to see that the government kind of pays attention to, retirement services constituents, if you will, in terms of trying to do the right thing and make things better. There are some gotchas here, meaning even though there are some tax breaks, so to speak, there's also some revenue enhancement features, which we're going to deal with towards the end of the presentation. Overall, what are they doing? Trying to make it easier for participants to be in qualified plans, trying to make it easier for people to save money, trying to make it easier for smaller businesses in particular to be able to sponsor retirement plans for their employees, right? They're trying to look to expand coverage in this country. And they're also giving some fiduciary relief to plan sponsors, which we'll get to, and improving some of the portability of some of the benefits at the participant level. So again, many of the features are effective right now in 2020. The way we laid out this presentation, all of the effective dates, I'm assuming we're just making reference to a calendar year plan, right? That's what most people have when we think about 401k plans in particular. Some of this legislation, by the way, does positively impact defined benefit plans. We'll get to that today too. So, with that said, there's going to be a big initial couple of years here where plan sponsors are going to have to operate their plan in what we call operational compliance. There are some amendments that are going to have to be done down the road, probably in 2022, unless that's extended and pushed out a bit more. So one of the first things I wanted to talk about, I think my slides got ahead of myself already. Yep, here we go. There's a provision in this law that allows long-term part-time workers to participate in their employer's 401k plan. By the way, in terms of the order of the presentation today, we kind of looked at where are the hottest questions, the most questions we've been getting over the last 10 days or so. And I think this one, kind of raised the attention of a lot of folks in the HR departments of our clients saying, oh my gosh, part-time workers have to be in the plan. What do I do about it? And when is this thing effective? Well, this piece of the law is effective in 2021. However, the real thrust of it doesn't really impact till 2024. So, you know what, this is a little bit of an easy one, but the crux of this is starting in 2021, we now need to start to look at anybody who works more than 500 hours a year, right? In some cases, clients make participants wait maybe up to a year and 1,000 hours of service, and essentially, they're enrolling participants in the plan who are working more than about 20 or 30 hours a week, right? Here, we're going to have clients start to track hours worked that are more than 500, right? More than 500, but less than the otherwise known as the statutory hourly requirements. And the way this thing works is if an employee works more than 500 hours, and if they wouldn't otherwise come into your plan, well, if they do that for 3 consecutive years, you need to enroll them actually in the 2024 plan year. So a fair amount of time to kind of gear up for it. So there's gearing up that would have to be done most likely at the reporting level for each of our clients, and also in terms of some of the systems we use if we're the record keeper or if there's an outside record keeper on your 401k plan. There's definitely some work that needs to get done. This is something that is in the law. It's got to happen. As with anything, there's always some options. While there's no requirement for you to contribute for these individuals, meaning you don't necessarily have to make a matching contribution. You don't necessarily, if your plan is known as a top-heavy plan, don't have to make top-heavy minimums. And if you're making regular or other profit-sharing type contributions, you don't have to give any of those types of contributions to any of these people who wouldn't otherwise meet your eligibility requirements. However, you can. It's like a lot of things. There's flexibility. So you're permitted to actually give these people contributions if you want. So the other wrinkle that comes along with that is a little bit of a different way of counting vesting for these people. So look, I'm not going to get into that aspect of it right now, but good news, I guess. Good news is people who were probably, previously precluded from participating can now participate. The other good news is even though these people may not necessarily participate or make the highest contribution levels, the good news at the plan sponsor level is they're not going to hurt you from a testing standpoint. And other than, covering them or letting them benefit in the plan, there really is no employer contribution cost associated with them. So that was one of the hotter questions we were getting in terms of clients being somewhat concerned about, gee, what do they have to do right now? And the answer is nothing much right now, but just be prepared for that coming up in 2021 in terms of counting those hours. Another feature that was in this new law, and again, it may not be the hottest topic, but for plans that automatically escalate contributions, right? There was previously a cap of no more than 10% salary deferral on the auto escalation. That's now being changed to an overall cap of no more than 15%. A little bit quirky in terms of how this one works. Basically, if you've got these auto contribution features, participants have to be subject to the 10% cap in year one, but then 15% thereafter. It's hard for me to envision any plan sponsor requiring 10% of pay or more in the first year. So, probably something that's not going to come into play for a lot of people. But again, this is one of those things, if you look at the effective date in the bottom right-hand corner of the slide, technically this thing is effective right now today. So if you're a plan that has auto escalation of contributions, it's something we probably want to sit down with you and take a look at. Excuse me. There is some simplification in this new law in terms of safe harbor notices, and it kind of comes into a couple of flavors. Again, I'm not going to necessarily get super technical on this call, but essentially you can get out of doing a safe harbor notice if you have no non-elective or if you have non-elective contributions. So it's really a very simple form of a safe harbor plan. There are some what I call gotchas here. If there are certain other types of contributions, you may still have to give out a notice. But there's also some real good stuff here too. So there's late adoption of certain safe harbor features that you're able to do. And some of those things can happen as late as 30 days before the end of the plan year, which again improves client or plan sponsor flexibility. There's also a feature that allows you to make one of these changes after the end of the plan year. And I think the way it's worded, up to 12 months after plan year end, you can still institute certain safe harbor types of contributions. So again, this is another one that's effective this year. This will ultimately be used as, I think, a pretty good planning tool for certain plans or certain clients that may run into testing issues, and it basically will give clients more flexibility much closer to plan year end and even after the end of the plan year. So this is a nice feature that, again, really benefits the employer in terms of flexibility. Obviously, participants benefit too if you're doing a safe harbor contribution and building in certain levels of contribution to the plan for their benefit. All right, let me move to the next slide. I may have gone too fast there. The next couple of provisions are, again, some pretty big ones, and a lot of it centers around the change in the required minimum distribution date, right, which has been moved from age 70 and a half up to age 72. So there's a couple of different implications here. It mainly affects, I'm going to say, the defined contribution and IRA side of the business, mainly. So, the way this works is if you were actually 70 and a half, or if one of your participants turned 70 and a half last year in 2019, well, they're kind of stuck with the old rules. It is what it is, so to speak. If they were 70 and a half last year, they had to commence either before the end of last year or no later than April 1 if they defer receipt of the first payment. So on the other side of the equation, if you're 70 and a half this year or in future periods, the new rules come into play. So I imagine a lot of record-keeping service providers like us, for that matter, there's a lot fewer new RMDs that we're going to have to do or start up with this year because of this change in law. The commencement age is put off. It was put off, I think, for a couple of reasons. When this was originally put in place, longevity isn't or wasn't what it is today. I think that's part of the reason. I think the other part of the reason is, the demise of defined benefit plans over the last couple of decades, the fact that there's a retirement savings shortage, so to speak, in this country. And, this is another mechanism to allow participants or individuals, for that matter, because this impacts IRA accounts also, to defer money for a longer period of time. And, with working lifespans increasing, so to speak, over the last couple of decades, it's a good thing. It's a little bit of flexibility. It doesn't do, obviously the government in the near term, right, loses some revenue because if people are not taking minimum distributions, most of those are taxable distributions, that would generally increase revenue for the government, tax revenue. So we'll see at the back end of this presentation, there are a couple of things that absolutely increase revenue for the government to offset things like this. And I guess it's under the heading of the law changing things in a relatively revenue neutral manner. So another big change on the IRA front is now being able to contribute to IRAs, regular traditional IRAs, that is, beyond the age of 70 and a half. Previously, that was only available in a Roth IRA feature. So that's a change here. That's gives individual participants the ability to save money and defer money for a longer period of time. By the way, and I'm not going to get into some of the nuances. There are nuances here that if you're contributing in those later years, there are some offsets that occur to certain, I think, charitable IRA contributions or distributions from IRAs that go to charities. So I would say check with your tax advisor on that if you're in the boat where you're contributing after age 70 and a half to an IRA. There are definitely some additional restrictions that kind of put in place with charitable contributions. There's another big change. This is the change in rules for, I call them certain inherited or stretch IRA distributions. A stretch IRA, definitionally, it was really I'll call it an estate planning strategy. And, I've spoken about this topic in the past. I've talked about the ability in the past to do what's called an intergenerational transfer of wealth, right, where you leave IRAs to certain beneficiaries and you can kind of extend, used to be able to extend the distribution period over the lifespan of those other beneficiaries. So by and large, this is going to be eliminated or is eliminated effective 1/1/2020. There are a couple of exceptions if the beneficiary of the IRA or the 401k or the retirement plan is a surviving spouse, life expectancy, distributions over that spouse's life expectancy can still occur. So a stretch IRA, so to speak, can occur for a surviving spouse. A couple of other categories where it can apply: disabled individuals who are beneficiaries. Another exception for folks, beneficiaries who are not more than 10 years younger. So, a couple of minor things, but by and large, the concept of, a child inheriting a parent's IRA where there's a, 15, 20, 25-year gap in age and spreading that distribution out over the child's lifetime, that strategy as a tax planning tool, estate planning tool, is gone. And again, that's another way of the government saying, well, here's a way to increase revenue, because if we're now forcing those beneficiaries to take that money over a period of not more than about 10 years, that's more tax revenue in the near term that the government can use to offset some of the favorable tax benefits that are built into some of the other provisions here. The next slide. Slides are going a little fast here. So the next slide we have is another change. Let's see if it's displaying. Just trying to get it to display properly here. There it is. This is a change again, effective January 1, 2020. That permits withdrawals of up to $5,000 from retirement accounts, penalty-free, excise tax-free, due to the birth or adoption of a child, right? And the way the rule is going to work is you can take this withdrawal. I think it works out to the 12 months following the birth or the adoption. And both parents, in theory, could take a distribution from their 401k or IRA account, for that matter. There is, obviously, taking money out means it's probably going to be taxable, unless it was some sort of an after-tax Roth contribution or pure after-tax contribution. But by and large, most people will pay federal and or state income tax on this money, but just no 10% excise tax penalty. There is a provision in the law that says that participants who avail themselves of this feature can actually repay the amount to their plan or their IRA. Probably going to need some guidance, definitely going to need some guidance on how that would actually work. I'm not sure that we know what the time frame is for the repayment of that distribution. But we do know that the law says the distribution, if it's repaid, is going to be treated as a rollover to either the IRA or to the qualified plan. So a lot of the features and provisions in this new law are really going to be a function of further guidance from the IRS and or the Department of Labor, because there's quite a bit here, and there's quite a bit that probably still needs some real good solid explanation of how things are actually going to work mechanically. So the next couple of things, there are three things that we kind of bundled together in this talking point. And it's in Title I and Title II of the Act. It really surrounds itself with lifetime income solutions. And, we like to think of this as a way to, how do we educate participants in a 401k plan to, quote unquote, pensionize their 401k? And what I mean by that is translate an account balance, whatever that account balance may be, into, what does that mean in terms of annual recurring income that I can generate for myself in my retirement years, right? We at PENTalk have been putting that number, if we're doing the record keeping, we've been showing a monthly benefit payable. I think we do the calculation at age 65. We basically already translate each participant's account balance to a monthly benefit at 65. So what this law says is it's mandating something we've already been doing for more than a few years. So all service providers, all record keepers, if you will, of 401k type plans are going to have to show what a participant's account balance will translate into as a monthly retirement income. It takes, by the way, fiduciary liability off the record keeper and the client, by the way, the plan sponsor, for how that calculation is done, because the DOL is going to come up with rules. They're also going to have service providers show that as a joint and survivor, qualified joint and survivor annuity. Again, to give participants a feel, because I think the typical participant in a qualified plan, doesn't really know that, gee, if they have an account balance of $400,000, what does that mean in terms of sustainable lifetime income? So that's one thing. So it's really under the heading of, I call it education and disclosure, if you will. The second thing ties into the ability of plan sponsors in DC plans, right, to actually offer lifetime income solutions. And, this has come up over the years. Matter of fact, we participated, the GAO called us, it was about, I think, 4 or 5 years ago at this point, and had questions about, gee, why don't plan sponsors of 401k plans include the ability for participants to buy an annuity? Basically take their account balance, buy an annuity and generate lifetime income from the plan. And one of the big issues I told them is it's really fiduciary liability. If you think about it, it's one thing to choose investments for a plan, right? Most clients either have a service provider, investment professional, help them with that process, and there's a process to go through. I'm not sure most clients, or most individuals for that matter, truly know how to scrutinize an insurance company and their ability to pay benefits and claims, and what do the ratings really mean, and how is the product really structured. There are a fair number of complexities there in terms of how that works. So one of the things I said is look, sponsors don't want to take the responsibility and ultimately the liability, right, for choosing XYZ insurance company as the annuity provider in their plan, because unlike a mutual fund, right, in your plan, if for some reason the financial condition of that insurance company degrades over time, 5-10 years out, you don't really have a ton of ability to just swap it out for another insurance company, right? Annuity contracts are not portable, is the point. So, the fear was, if I name an insurance company today, is that going to be the best company to have in my plan forever? The answer is maybe, but maybe not. So the new law basically says, look, as long as you do, I'm going to sum it up as reasonable diligence, and some of this you can rely on reports from the insurance company itself as long as it's written. But if you do reasonable diligence and the cost is not necessarily the cheapest for the annuity, but within reason, that you would have fiduciary protection in terms of choosing an annuity provider for your plan. And the law ties into the third section of this, which is portability. If at a point in time in the future you decide, gee, that provider is not the right provider for the plan, you can actually drop that insurance company, name a new one, and the law basically permits the participant to move their annuity contract either to an IRA or another source, another solution to keep it so they don't face liquidation fees or charges or things of that nature. So overall, I mean, it sounds a little complex. It really isn't, and it really, in my mind, opens up flexibility and helps reduce the fiduciary liability of adding another option within the plan. So overall, I think this is good stuff here, and it's something we've been talking about for a number of years that may be beneficial to the participants down the road as they try to convert 401k balances into monthly income for life. There's another feature that I know a lot of our clients are going to be interested in. It protects older, longer service participants in certain closed defined benefit plans. So, these are plans where there may be a subset of the employee population who continues to benefit from the plan. We actually call it more of a soft freeze, meaning no future participation in the plan. And the issue with a defined benefit plan with a soft freeze is it can run into non-discrimination testing issues down the road. So a couple of things, by the way, we're at some point going to do a much longer session on this one in particular because there's a lot here. Couple of quick takeaways. Everything you read in the press, it's not going to be as simple as it sounds, where automatically anybody with a soft frozen plan is immediately going to be okie dokie, right? It's not going to be that simple. There are certain hurdles to jump through and hoops to jump through in the plan, if it was frozen as of a certain date, and if the testing worked for the year in question, and for a couple of succeeding plan years after that, the testing had to work. And if you freeze a plan in the future, in terms of participation, how does that work? So there's a bunch of different rules. I'm expecting there's definitely going to be some more guidance on this down the road. But if I were to say, is it a good thing? It's definitely a good thing. One of the big things that I think is going to help a lot of our clients is the ability to cross-test, that's maybe not the best word in this context, but use a DC plan to help out in terms of some of the testing on these frozen DBs or soft frozen DBs, where the plan years are different plan years, right? It's not uncommon for some of our clients or a lot of them to have a calendar year 401k and an off-calendar year defined benefit plan. So the relief that was issued in the past, the plan years had to be identical. So that's off the table. This new law specifically says you don't have to have a common plan year. Great news. Number two, it explicitly says certain benefits, rights, and features kind of get a free pass, again, if you meet certain of the conditions that I mentioned earlier. So also there's a provision here that allows you to do what's called a makeup benefit for certain DB plan participants, right? Where you want to try to make them whole to the extent that you can through the DC plan. There are certain exemptions on testing in the DC plan for that kind of a strategy. So it opens up, in my mind, a whole lot of opportunity for a lot of these soft frozen defined benefit plans and gives those clients more flexibility down the road. I think if we're looking at, well, what are the next steps here? Next steps are, do you have a soft frozen plan, right? Number two, did it pass the non-discrimination rules for the years in question, right? Number three, is it likely to run into a testing problem over the next couple of years? The fourth takeaway is, if it is, then we should help you determine, is it a plan that can actually afford itself with the new flexibility of these new rules? And if yes, we can take it a step further and see if the new rules actually help. So there are things, we can start to do right now. And this piece of it is piece of the law is effective immediately, and actually, at your option, retroactive back as far as 2014, by the way. So more to come. We're going to do some more analysis on this over the coming weeks, and we'll probably be looking to schedule another webinar solely on defined benefit impacts. This next section was expanding certain aspects of open multiple employer plans and PEPs. I'm not really going to spend time on this today. We actually did a separate webinar on this a couple of weeks ago. So if you wanted to grab a copy of the recorded version, send us an email and we'll get that to you. But bottom line is this feature is not going to be effective, or these plans are not going to be effective until 2021. And we're expecting more guidance on this in any event. So we're definitely going to be doing more work on this and looking at this more closely to see where it may make some sense for our clients. A couple of other things for new plan formation. So there are certain tax credits that have been expanded if you're a client or a plan sponsor who's adopting a new plan for the first time. And the credits, tax credits have been increased over what they were, and there's an additional tax credit for new plans that are establishing automatic enrollment features. So again, this is really the government kind of supporting what we've been saying for years is we need broader coverage, participant coverage, if you will, in retirement plans across the country. We need more employers to step up and begin to sponsor a plan, and we need to make the administration of these plans as easy as it possibly can be. And allowing these tax credits is a way to help offset the startup costs of putting a plan in place. This next slide, establishing a new plan, we actually get at PENTalk a fair number, probably upwards of 50 or 60 new plans established each year. A lot of them happen to be defined benefit plans, but some are 401k. This now, in the past, you had to adopt your new plan no later than the last day of the plan year, typically December 31. This basically says you can adopt a plan retroactively. So, for example, a calendar year taxpayer would typically have a corporate return due on March 15th of the following year. Well, if they file on time, they can actually adopt a new plan retro to last year as late as March 15th. Similarly, if they go on extension till whenever that takes them, middle of September, they have until that extended deadline to establish a new plan. So really this helps a lot of these smaller employers who put plans in place. A lot of them are tax strategy type plans. How do we shelter income in a small business, potentially benefiting owner employees, that sort of thing. So at the end of the day, these small plans still cover rank and file employees. So, in my mind, it's better to have a plan that benefits some rather than not having a plan at all. This provision changes in-service distribution dates for defined benefit plans as well as for certain 457B plans. This was part of the Minors Act. There was also another thing they slipped in there in terms of funding relief on minors, DB funding requirements, something like that. I'm not going to cover that. But here, the change applies to any defined benefit plan, can now have technically an in-service distribution feature as early as age 59 and a half. And, part of the logic there is the concept of phased retirement, right? If you've got older employees in your organization who are looking to retire and maybe looking to cut back from 5 days a week to 4 days or 3 days, here's a way where potentially they could draw income from the defined benefit plan, as well as working fewer hours, than they were, and kind of phase into retirement. I think that's the concept here. So this pretty much brings parity with the typical 401k design, right, which permits in-service distributions as early as age 59 and a half. Here we go. This is the real gotcha stuff. Title 4. Revenue provisions. I'm not even going to talk about them all. I'm only going to talk about the ones that impact qualified plans. The government has now increased taxes and penalties pretty much to the tune of 10 times what they were. So, increases in failure to file are out there. Increases in, I'm going too fast on my slides, increases are skyrocketing, literally exponentially here is the bottom line. So it's going to be more critical than ever to make sure certain tasks are done, 5500s are filed timely, so on and so forth, because the penalty amounts have just become extraordinary is the bottom line. And again, that's effective this year. And I presume, if you have a late filing for a 2020 plan year or later, that's going to be problematic. And I have no idea if the IRS is going to have the ability to soften or reduce or waive taxes, those types of excise taxes and penalties. Typically, it's hard to get out of those things. So you need to be more diligent than ever to make sure that stuff gets done on time every time. Mandatory plan amendments, typically, they're not going to be required until 2022. What I said earlier in the discussion today is, a lot of these features are effective right now, as I mentioned. A lot will be phased in later on. Some of the features, even though they're effective, there are various options you can choose. So, operational compliance in the interim is going to be key in terms of, kind of keeping track of what are we recognizing, what are we not recognizing, how are we doing things, because ultimately there's got to be a codifying amendment that gets done sometime in 2022. So that's something that kind of comes down the road. And again, I'm sure there's going to be some interim guidance, definitely going to be some guidance, hopefully along the way, that helps clarify a number of the provisions that are kicking in. So there was a lot here. I think we covered. We're going to open up for a couple of questions now. We do want to be cognizant of the time because we didn't want this to run past another 5 or so minutes today. So we'll open up for questions. We'll see if there's any here. But again, I think we covered 19 or so items. There's a bunch of others that I didn't talk about that are not specifically retirement plan related, or they may impact union plans, for example. There's something out there that impacts church plans, which I'm not sure this audience is needs to go there. If you have questions on those, the couple of things that we didn't talk about, again, feel free to reach out or email us, and we'll do our best to get answers on any of the topics we didn't cover. So, Beth, I don't know if you're still on the line. Are there any questions we can try to address?
Yes, we do have a couple of questions, and I just want to say before we get into the questions, just a reminder, we do have in the handout section a couple of items that you can download. Do that now before we get off the presentation. Also, you will receive an email tomorrow with a link to replay the webinar if you want to do that. So let's get into some of the questions. I think, Rich, you did touch on plan amendments. Someone has asked, do we have to do plan amendments for all of the provisions? And if we do, what is the process to get that started?
So, and yeah, I answered most of that. I mean, I guess there's a kind of a hidden one in there, a hidden question, which is for all of certain things you don't need to amend. For example, the required minimum distributions going to age 72. That's just going to be out there. So there are a couple of things that don't need a specific amendment. But most of them, believe it or not, need an amendment, kind of a codifying amendment. We're already looking at, what sort of drafts can that look like, and hopefully make it as easy as possible for clients to get their plans amended. But again, as I mentioned before, operational compliance in the interim is going to be key, as well as just making sure we get the amendment done, or you get the amendment done if we're not working on your plan specifically. So, yep, that's more to come on that as we get more from the IRS and DOL.
Great. Another question related to the birth adoption distribution. I know you said that can be repaid. Do we have guidance on when or how long we have to repay that?
Yeah, that's a good question. I didn't, I've looked at this thing, the new law, more than a few times. I'm not sure I really saw anything on the repayment option. I think that's one of those things that we're going to. Well, I saw it on the repayment option. I didn't really see anything on the time frame, or if I did, I don't recall what it is. So it's either more guidance to come, or maybe what we'll do after this call is go back and look at it and see if we can uncover any more on that, on the repayment period. And the mechanics of, the other questions I have, by the way, the mechanics of that repayment. If I've already taken a distribution, right, within 12 months after the birth or adoption, at some point I probably would have paid income tax on that distribution. And now if I can repay that, I'm making this up, 2 years down the road. Well, yeah, what does that mean? I guess I got to do an amended filing. It sounds like it could be a little bit probably complicated is the point. So we're going to have to look to probably some guidance on that to get some more information.
All right, we have an RMD question. If a participant turns 70 and a half in 2019, are they still required to take their RMD as of April 1st, 2020?
Generally speaking, yes. They're under the old rules. There are some limited exceptions, right, if you were an active participant in a qualified plan, but by and large, you're subject to the old rules, which had a starting date of either December 31 of last year or April 1. You could defer, your first RMD to April 1 and then take a second one by the end of this year. So, it's kind of a hard and fast, and I think the date is if you were, hopefully I don't mess up the dates, I think if you were born after June 30th, 1949, that means you're not 70 and a half until 2020 or later, and you're subject to the age 72. But it's a bright line on that rule.
Great. Okay. Well, there are more questions, but we are about out of time, and I fear that these would be too long. So we will answer your questions. We will be back in touch with you. Rich, thanks for hosting today. Appreciate your time. Appreciate everybody on the line joining our PENTalk series as we kicked off the new year. We'll have more during the year, so look for those invitations. Again, you'll receive a email tomorrow with the link to replay the webinar. And also, you'll have an opportunity to email questions to us if you need to do that. Thank you again for your time, and enjoy the rest of your afternoon. Thanks, Rich.